In this video, I'm going to reference some things about process costing. Process costing is used when there is mass production of similar products, where the costs associated with individual units of output cannot be differentiated from each other. In other words, the cost of each product produced is assumed to be the same as the cost of every other product. Under this concept, costs are accumulated over a fixed period of time, summarized, and then allocated to all of the units produced during that period of time on a consistent basis. When products are instead being manufactured on an individual basis, job costing is used to accumulate costs and assign the cost to products. When a production process contains some mass manufacturing and some customized elements, then we're probably going to use a hybrid cost method. So that is usually called a hybrid costing system. Examples of the industry where this type of production occurs usually is in something like oil refinery, food production, and chemical processing. For example, how would you determine the precise cost required to create 1 gallon of aviation fuel when thousands of gallons of the same fuel are gushing out of a refinery every hour? The cost accounting methodology used for this scenario would be process costing. Process costing is the only reasonable approach to determining product costs in many industries. It mainly uses most of the same journal entries found in job costing, so there is no need to restructure the chart of accounts to a significant degree. So this makes it easy to switch over to a job costing system from a process costing system if the need arises, or to adopt a hybrid approach that uses portions of both systems. I'm going to give you some points here. In addition to what it's saying on these slides here, I'm going to go speak about what's on this slide right here. It says a process cost system is used when goods or services of a similar nature are provided, and I already indicated that. And as it says in the last bullet point, the primary objectives are not to compute the unit cost of the products completed and the cost of those assigned to the ending work in process inventory. So mainly just trying to compute everything put together and trying to have a better analysis, right? And what is it saying here is that indirect materials obviously influence the process costing system, okay? So indirect materials that can't be directly associated to a particular department are going to be charged to factory overhead, so something for the overall factory. So in addition of this, I guess an example of this would be maybe you're utilizing some of the utilities. The utilities can be the electricity for the lights. Now, how can you dissect that as far as lights being on when the lights are on for the factory in general? So it's hard to say that the electricity being on so we can have lights to produce this product has a direct influence on the cost of this product. We don't actually know that. As it says here, the unit cost of each department is calculated by dividing the total cost charged to the department by the number of units produced during the period, right? So as a process costing example, let's say ABC International produces purple widgets, which require processing through the multiple production departments. The first department in the process is the casting department, where the widgets are initially created. During the month of March, the casting department incurs $50,000 of direct material cost and $120,000 of conversion costs. So these conversion costs are comprised mainly of direct labor and factory overhead. The department processes 10,000 widgets during March, so this means that the per unit cost of the widgets passing through the casting department during that time is $5 for direct materials and $12 for the conversion costs. right? So all we're going to do in this instance is that what I did was divide 50,000 divided by the 10,000 widgets and $120,000 divided by the 10,000 widgets. That's how I got my $5 and $12. So that's an example of what it's referencing here when it's speaking about the department by number of units produced during that period. As it says here, departments record costs according to the following procedure. We have the cost of materials, labor, and factory overhead, directly identifiable with a department are charged to the department. Of course, it has to be directly correlated, right? We have a second point to consider, the cost of the factory services, okay? What is carried over from other departments. And I guess I can further tell you about 3 different types of processing, right? 3 different types of processing. One is a weighted average cost. I'm sure we've heard that term probably in economics, but weighted average cost. This version assumes that all costs, whether from a preceding period or the current one, are lumped together and assigned to produced units. It is the simplest version to actually calculate. Then the second one we may have is standard cost. Standard cost. This version is based on standard cost, of course. Its calculation is similar to weighted average costing, but standard costs are assigned to production units rather than actual costs. After total costs are accumulated based on standard costs, these totals are compared to actual accumulated costs, and the difference is charged to a variance account. And lastly, we have something called first in, first out costing, FIFO. So FIFO is a more complex calculation that creates layers of costs. One for any units of production that were started in the previous production period but not completed, and another layer for any production that is started in the current period. And what I want you to realize is there is no last in, first out, which is LIFO costing method used in process costing, since the underlying assumption of process costing is that the first unit produced is in fact the first unit used, which is the FIFO concept.